One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. My name is Alex Mason and I am your host. This is the show dedicated to helping you understand both the technical and non-technical aspects of the investment banking interview process. That's why we're here. We're trying to move into this career. Maybe we don't have a background in finance and we're just trying to figure it out. So that's what we're doing. And we're going through every single question that I can get my hand on related to these interviews. Specifically, we're focusing a lot on the technical aspects because there's just so much to know. But we did go through a lot of behavioral aspects in the first several episodes. And look, we're talking right now about convertible bonds. We talked last episode about how to account for them when calculating enterprise value. And so we understand fundamentally that convertible bonds, that word convertible means that debt can transform into equity. And that can change the calculation. So it just depends on whether or not the bonds are in the money, essentially. So check out the last episode if you want a refresher on that. But today we're going to be going through an example specific to convertible bonds and how the dilution works. So let's go ahead and jump right into this. Imagine that a company has 1 million outstanding shares that are trading at $100 per share. And then it also has $10 million of convertible bonds. And these convertible bonds have a par value of $1,000 and a conversion price of $50 per share. Calculate the diluted shares outstanding. Now go ahead and repeat that because there's a lot of information there. So imagine a company has 1 million outstanding shares trading at $100 per share. All right, that's one part of it. It also has $10 million of convertible bonds with a par value of $1,000 and a conversion price of $50 per share. Calculate the diluted shares outstanding. So the way we're going to work through this is we're just going to go to the basics and build up from there. That's how we approach all of these problems. If we don't understand the fundamental definitions of what things mean and how they work, we're never going to be able to put them together. So first of all, shares outstanding. Diluted shares outstanding versus basic shares outstanding. Basic shares outstanding is just the amount of stock that you have out there right now that already exists. Diluted shares outstanding tells you the final total amount of shares that are going to exist after all sorts of options and dilutive securities have been exercised. And in this case, convertible bonds is a type of dilutive security. So we know that it's going to be different than just the 1 million shares trading at $100 per share. So that's what we know first. There's 1 million shares outstanding right now. Now we need to understand how many convertible bonds are we working with? The question said that we have $10 million worth of convertible bonds, but how many actual individual bonds do we have? Well, if there are $10 million worth of convertible bonds, and the par value is $1,000, we can divide to get the number of bonds. So in this case, $10 million divided by $1,000 equals 10,000 convertible bonds. And I want to explain really quickly what I mean by par value, because that's another one of these little terms that they kind of throw at you that you just need to understand. So par value, this is what I like to think of as the floor value of the bonds. So when the bonds are initially created, they're given this par value. So $1,000, that's like the base level of the bond. And typically you can't go below par value. You can only go above it. And you also see that term par value used for common stock. So if a corporation is created and there are shares that are issued as part of the creation of the corporation, there will be a par value set for the stock. Sometimes it'll be $1 or something like that. So the stock will have a par value of $1. So in this case, we're given the par value of the bonds, $1,000, and we're just dividing it into the $10 million of total bonds that we know. And that gives us 10,000 convertible bonds that are out there. So, okay, quick recap. We've got this company, it's got 1 million shares outstanding, but we also have these 10,000 convertible bonds that are out there. Now, we also know that the conversion price is $50. And remember, we talked about this concept of being in the money or out of the money. If our dilutive security conversion price is below the current share price, boom, we're in the money. So if you owned a convertible bond at $50 and the share price was $100, then you could convert that security and make money right there, because you can exercise at a lower price than the current market price. If the exercise price for your convertible bond is above the market value of the shares, then you can't exercise that. It just wouldn't make sense. So remember that little principle there about being in the money or out of the money. So in this case, we know that we're in the money. Since the conversion price is $50, the market price of the shares are trading at $100. Now, when the bondholders decide to convert the stock, the next thing we need to know, and this is a critical piece, we need to know how many shares of stock they're getting for each bond. We can't just assume that as a bondholder, you're going to exchange one bond and get one share of stock back. Because if that was true, then we would just add 10,000 to 1 million and say, okay, total diluted shares outstanding, 1 million, 10,000, and we're done. But that's not true. We need to account for this conversion before we do that addition. So if we take the par value of the bonds and then divide it by the conversion price, that'll tell us how many shares are created per bond. So if there's $1,000 par value for each bond and the conversion price is at $50 per share, well, then $1,000 divided by $50 per share equals 20 shares of stock for each bond that's converted. So for every single bond that's converted, we're going to get 20 shares of stock. And of course, we had to be in the money to exercise this bond, this convertible bond. Okay, so now that we know that, that's the conversion ratio, how many shares are getting created? Well, we started with 1 million shares. And so if 20 shares are getting created for each bond, and we already know that we have 10,000 bonds, then we have to multiply the number of bonds by the conversion rate to get the total number of new shares. So we take 10,000 convertible bonds, and again, they're all getting converted, by 20 multiplied by 20 equals 200,000 new shares. Now, we might ask ourselves the question, how much is the company getting out of this? Because remember, several episodes ago, we worked through an example where there were some stock options that were getting exercised, and we had to do some math accounting for the company getting some money out of that, out of those options being exercised, and then buying back shares. And that's called the treasury stock method. But here, we have to take note of what the security actually is and what's happening. The bondholder is converting the 10,000 bonds, but they're not actually paying the company any additional money in order to do this. Those bonds were issued and the company got the money when the bonds were issued. Okay? So treasury stock method here does not apply. So what's happening to the total fully diluted share count? Well, we start with the 1 million shares, and then we add the 200,000. And remember how we got that. We had 10,000 convertible bonds multiplied by 20 equals 200,000. And that leaves us with 1.2 million shares. And that is the answer to the question. And I think the key here is to realize that the bond to stock conversion ratio is dependent on the par value of the bond divided by the price, the conversion price or the exercise price. And then also another key is to realize that the treasury stock method doesn't apply to this convertible security. So those are the things that I was thinking of when working through this problem. And I hope that that helped you. And just a quick recap what we did. We had 1 million shares outstanding trading at $100 per share. There's $10 million of convertible bonds with a par value of $1,000 and a conversion price of $50. And the question is, calculate diluted shares outstanding. Well, in order to understand the total number of bonds that are out there, we take our $10 million of convertible bonds, divide it by the par value, which is $1,000, and that tells us that we have 10,000 convertible bonds. Now, the exercise price is $50, which is lower than the market value of the shares at $100, so we can exercise these bonds fully. And we also need to understand, what is the conversion ratio? How many shares of stock are being created per bond that's being converted? And we do that by taking the par value of the bonds, $1,000, and dividing it by the exercise price or the conversion price of $50. 1,000 divided by 50 equals 20 shares of stock per bond converted. We take that 20, multiply it by the number of bonds that exist, 10,000. 20 times 10,000 equals 200,000 new shares. And so we take that 200,000 shares, add it to the original amount of shares, 1 million that we started out with, and the fully diluted shares outstanding equals 1.2 million shares. Okay, so that's what we got as far as a convertible bond dilution example. And I hope you understood that. It was great. It took me a little bit to fully understand that myself when I was first working through it. So, but yeah, that's a convertible bond dilution example for you. So that's what we have. And what we're going to be talking about in the next episode is a very fundamental question relating to equity value versus shareholders' equity. Joining me next time on Investment Banking Insights. I'll see you next time. Bye.